Picture your money sitting in exactly one place, one checking account. Paycheck goes in, bills come out, whatever's left just sits there until it gets spent on something else. No separation, no structure, no plan, just one pool of cash doing every job at once. This is how most people bank, and it's quietly one of the most expensive habits in personal finance. Not because checking accounts charge outrageous fees, but because when every dollar lives in the same place, every dollar gets treated the same way. Your emergency fund isn't protected from a random Tuesday impulse purchase. Your rent money isn't protected from a rough month. Nothing has a job, so everything gets treated as available. Here's what changes when you separate your money by function instead of leaving it in one account. Each dollar starts behaving the way you actually need it to. Money you can't touch stays untouched. Money you're investing actually grows instead of sitting flat. Money for bills never accidentally gets spent on something else because it's not sitting next to your spending money in the first place. Today, I'm walking through the 5 accounts that do this, what each one is actually for, why the account type matters as much as the money in it, the specific mistakes people make with each one, and the order you should actually set these up in, because doing this in the wrong sequence is exactly why so many people try this once and give up. The first account is your checking account, and I'm starting here because most people already have one, but almost nobody uses it correctly. Your checking account should be the account where money flows through, not where it lives. Paycheck lands, bills go out, and whatever's designated for spending gets spent from here. The mistake most people make is leaving everything else in this same account too. Savings, emergency money, irregular expenses, which turns checking into a single undivided pool where nothing is protected from anything else. A checking account should be boring, ideally free, no minimum balance requirements, no monthly fees eating into money that's just passing through. If you're paying a monthly maintenance fee on your checking account, that's usually a sign you're either not meeting a minimum balance requirement or you're at a bank that charges for basic access to your own money. And there are plenty of options, especially online banks, that charge nothing at all for the exact same function. The most common mistake with checking accounts isn't the fees, though. It's letting the balance grow past what you actually need for the month, simply because moving it somewhere else feels like an extra step. A checking account with $6,000 sitting in it, earning close to nothing in interest, isn't a safety net. It's just money that hasn't been assigned a job yet. If you regularly see a large cushion build up in checking, that's not evidence of financial health. It's a signal that money needs to be redirected somewhere it can actually work, whether that's savings, investing, or paying down debt. The second account is a high-yield savings account, and this is where the actual separation starts to matter. This account holds your emergency fund, money you're not investing, not touching for anything routine, just sitting there in case something goes wrong. The traditional advice is 3 to 6 months of expenses, and while that range is useful as a target, it shouldn't stop you from starting. Even a small amount sitting in a dedicated account changes how you experience financial stress. Research from Vanguard found that people with just $2,000 in emergency savings report financial well-being scores 21% higher than people with none, the largest boost tied to any single financial factor they measured. Here's why the account type matters specifically. A regular savings account at a traditional brick-and-mortar bank might pay you close to nothing in interest, sometimes a fraction of a percent. A high-yield savings account, usually through an online bank, can pay meaningfully more, often several percentage points higher, for the exact same level of safety and access. Your money is FDIC insured either way. The only difference is whether your bank is paying you a competitive rate or counting on you not to notice that it isn't. Let's actually run this comparison with real numbers, because the gap is bigger than it sounds. Say you have $8,000 in emergency savings. At a traditional bank paying close to 0.05% annually, that $8,000 earns you roughly $4 a year. At a high-yield account paying a meaningfully more competitive rate, that same $8,000 could earn you several $100s a year, sometimes more than $300, depending on current rates. That's the difference between a bank quietly keeping your money's earning power for itself and a bank actually paying you for the privilege of holding it. Same balance, same safety, same access. The only variable is which account it's sitting in. This account also needs to be separate from your checking account, specifically because of how human behavior works. Money sitting in the same account as your spending money gets mentally categorized as spendable, even if you've told yourself it's for emergencies. Money in a completely different account, ideally at a different bank so it's not one click away, stays psychologically protected in a way that a labeled sub-account in the same bank often doesn't. The common mistake here is treating this account like a second checking account, dipping into it for things that don't actually qualify as emergencies, like a sale on something you wanted, or a slightly tight month that isn't really an emergency so much as a spending pattern that needs adjusting. Every time this account gets used for a non-emergency, it resets the psychological safety net back to zero, and you end up rebuilding the same cushion over and over instead of letting it actually grow past the point where it changes how secure you feel. The third account is a retirement account, and this is the one people delay longest, usually because it feels complicated or far away. It doesn't need to be either. If your employer offers a 401k with any kind of matching contribution, that match is the single highest guaranteed return available to you anywhere. If your employer matches 50 cents on every dollar you contribute up to a certain percentage of your salary, that's an immediate 50% return before your investments have grown a single cent. No index fund, no stock, no investment strategy anywhere comes close to guaranteeing that. If you don't have access to an employer match, or you want additional retirement savings beyond it, an individual retirement account, a Roth or traditional IRA, gives you a tax-advantaged account you control entirely yourself, usually with lower fees and a wider range of investment options than many employer plans offer. The specific choice between Roth and traditional comes down to whether you expect to be in a higher or lower tax bracket later, but the version of this that actually matters for most people isn't picking the perfect option, it's starting it all. Time in this account matters more than the amount, and the math on this is worth sitting with for a second. Someone who starts investing $200 a month at age 25 and earns an average 8% annual return will have significantly more by retirement than someone investing double that amount, $400 a month, starting at age 35. The first person contributes less money overall across their working life, but the extra 10 years of compounding does more heavy lifting than the higher monthly amount ever could. This is the entire argument for opening this account now, even with a small contribution, instead of waiting until you feel like you have enough extra income to do it properly. There is no version of later that beats now, no matter how much larger the eventual contribution is. The most common mistake with this account isn't failing to open one, it's opening one and then not increasing the contribution as income grows. Someone who starts contributing 5% of their salary at their first job and never revisits that number is leaving significant future growth on the table, simply because 5% felt like the right amount years ago and nobody ever came back to reconsider it. The fourth account is a taxable brokerage account, and this is the one that surprises people because it doesn't come with any special tax advantages at all, and that's exactly what makes it useful. This account exists for money you want invested for growth, but that you might need before retirement age. No contribution limits, no early withdrawal penalties, no restrictions on when you can access it. A house down payment 5 to 10 years out, a future business, a bridge to retirement if you're planning to stop working before you can access your retirement accounts, penalty-free. This is the account that handles those goals. The trade-off is tax efficiency. Dividends and capital gains in this account get taxed along the way, unlike a retirement account where growth happens tax-deferred or tax-free. Over decades, that difference compounds into a meaningfully different ending balance for the exact same contributions and returns. Here's a comparison that makes this concrete. Invest $500 a month for 30 years at a 7% return inside a tax-advantaged retirement account, and you'd end up with somewhere around $610,000. Invest that same $500 a month at the same return in a taxable account, paying taxes on dividends and gains along the way, and you might end up closer to $500,000 instead, over $100,000 less from the exact same contributions and the exact same market performance. That gap is entirely the cost of taxes eating into growth year after year, which is why this account should be filled after the tax-advantaged ones, not before. This is why the order matters. Max out the accounts with tax advantages first, the employer match, then retirement accounts, before routing money here. This account is for flexibility, not for being your first stop. The most common mistake with brokerage accounts is treating them like a savings account with better returns, meaning people check the balance daily and panic during a downturn, selling investments at a loss out of anxiety, rather than letting the account do what it's actually designed to do over a long timeline. A brokerage account you're checking every day is an account you're far more likely to make an emotional decision with. The people who do well with these accounts tend to be the ones who fund them consistently and then mostly leave them alone. The fifth account is one almost nobody talks about, and it's a dedicated account for irregular expenses, the ones that don't happen monthly, so they never make it into a typical budget, but that absolutely will happen at some point in the year. Car registration, annual insurance premiums, holiday spending, a friend's wedding, home or car maintenance that isn't a true emergency, just an expected cost that happens to arrive all at once instead of spread evenly across 12 months. This is the account that quietly saves people from thinking they have a spending problem when really they have a forecasting problem. Here's a concrete example of how this plays out. Say your car registration renews annually at $180. Your car insurance renews twice a year at $420 each time, and you typically spend around $400 during the holidays. Add that up, and you're looking at $1,420 a year in expenses that are completely predictable, but don't show up in any single month's regular budget. Spread evenly, that's about $118 a month. Without a dedicated account, that $118 a month doesn't disappear. It just shows up unpredictably, in a lump, at whatever moment the bill happens to land, usually looking like a crisis that came out of nowhere, even though every single one of those expenses was entirely foreseeable. With a dedicated account, $118 a month moves automatically into this account, and by the time car registration or the holidays roll around, the money is already sitting there waiting. The expense doesn't feel any different in terms of what it costs you. You're spending the exact same $1,420 a year either way. What changes is whether that spending derails your month or gets absorbed without you even noticing, because it was already accounted for the moment it happened. The common mistake here is not creating this account at all, and instead treating every irregular expense as a surprise, which usually means pulling from an emergency fund that was meant for actual emergencies, or worse, putting it on a credit card and paying interest on an expense that was completely predictable a year in advance. Here's the sequence that actually matters, because setting these up in the wrong order is a common reason people start this system and abandon it within a few months. Start with checking and a basic emergency cushion in high-yield savings. Even a small one, a few $100s, just enough to stop a minor emergency from becoming a credit card balance. Then, if there's an employer match available, contribute enough to capture the full match before anything else, because that guaranteed return outweighs almost every other priority on this list. From there, keep building the emergency fund toward a fuller 3 to 6 month cushion. Once that's solid, layer in the irregular expenses account, because this is usually the smallest amount needed relative to how much stress it prevents. Only after all of that is in place does it make sense to route additional money into a taxable brokerage account for goals beyond retirement. The mistake most people make is trying to fully fund all 5 accounts simultaneously from day one, spreading a small amount of money so thin across 5 places that none of them actually accumulate fast enough to feel like progress. It's better to fund these in sequence, get the earlier ones to a meaningful level, and then add the next one, than to move $20 into 5 different accounts and feel like nothing is actually happening anywhere. There's a psychological benefit to this separation that goes beyond the math. When your emergency fund lives in a completely different bank than your checking account, dipping into it for a non-emergency requires a deliberate, slightly inconvenient action. Logging into a separate account, initiating a transfer, waiting a day or two for it to land. That friction is the point. It's not there to punish you. It's there to make sure that when you do access that money, it's because you actually need it, not because it was one tap away during a moment of impulse. The same logic works in reverse for your retirement and brokerage accounts. Because they're not sitting in your everyday banking app, you're not checking them daily, which means you're far less likely to panic sell during a market downturn or make emotional decisions based on short-term fluctuations. Out of sight, in this specific case, works in your favor. It's worth naming the biggest mistake that spans all 5 accounts, because it's less about any individual account and more about the overall approach. People treat this like a one-time setup instead of a system that needs occasional revisiting. Life changes. Income goes up, rent increases, a new irregular expense enters the picture, an employer changes their match policy. An account structure that made sense 2 years ago might not reflect your life today. This doesn't mean overhauling everything constantly. It means checking in on the structure once or twice a year, the same way you'd check in on anything else that's supposed to be working quietly in the background. Let's talk about how to actually set this up, because understanding the 5 accounts doesn't help until they exist. This week, if you don't already have one, open a high-yield savings account at an online bank and move whatever you can, even $50, into it as the start of an emergency fund. This is the single highest leverage move on this entire list because it's the account most people skip and the one that prevents the most damage when something goes wrong. This month, check whether your employer offers a retirement match, and if they do, confirm you're contributing enough to get the full amount. If you're not employed somewhere with a match, look into opening an IRA. Most major brokerages let you open one in under 15 minutes with no minimum required to start. Over the next few months, once your emergency fund has some real cushion in it, open a small, dedicated account for irregular expenses and set up an automatic transfer, even a small one, timed to your paycheck. Add up your own predictable annual expenses the way we did earlier: registration, insurance, holidays, anything that hits once or twice a year, and divide that total by 12. That number is what should be moving into this account every month. And once the earlier accounts are solid, open a taxable brokerage account for any goal that falls outside retirement: a house, a future business, early financial independence, and route additional savings there once your tax-advantaged options are maxed out. Once a year, revisit the whole structure. Has your income changed? Has a new irregular expense entered your life? Did your employer change their match policy? A few minutes of review once a year is enough to keep this system matching your actual life instead of the life you had when you first set it up. None of this requires a complicated system or a financial advisor. It requires 5 accounts, each with one job, set up in an order that actually works with how you get paid and how life happens. The version of you with one undivided checking account and the version of you with 5 accounts, each doing exactly what they're supposed to, aren't separated by income. They're separated by structure. And structure is the one thing that's entirely within your control, starting with the very next paycheck that lands in your account.